Enactment of a distributed profits tax in Poland would be a good opportunity to increase in domestic investment in the economy. So one thing we found from our study is that switching the timing of taxation from accrual under the current system to the point of distribution reduces the total effective tax rate on investment in the Polish economy. Specifically, we found that it would increase domestic investment permanently by 3.3%, and the total capital stock by the same amount, and that would result in a larger economy in the long run, but also, more importantly, higher wages and salaries for workers. The larger capital stock makes workers more productive, able to produce more goods and services with the same amount of input, the same amount of hours worked, and that results in higher wages and take-home pay for these households. Another aspect of the distributed profits tax that our paper doesn't directly model but is very important is that it would greatly simplify tax filing. There's more than one way that a system can encourage investment or eliminate the distortions under the current tax systems, but some ways are more complicated than the other. The distributed profit tax would go down the route of being both a simple tax system and one that doesn't discourage too much investment. No matter what tax system you enact, there's always going to be trade-offs. So the distributed profits tax, it's going to reduce the tax burden on new investment, but the other side of that is that investment, it's producing net income that is being taxed by the federal government. If the base of the tax is smaller, you're taxing investment less, you're going to get less revenue. Our initial estimates found that revenue in Poland would fall by about half. But that depends on a number of assumptions. It's possible it reduces revenue by less than that. But that number also doesn't consider the fact that the economy in the long run will be larger due to the more investment, and we think that cuts the price tag in to about a half that ultimately. And then another issue that Polish lawmakers should consider is transitioning from the current tax system to this new distributed profits tax. One issue that's very important is that under the current system, retained earnings are currently taxed. And if you, this year, earn profits and retain those, they're going to be taxed. But if next year the Polish government enacts a distributed profits tax, there's a chance that those same profits are then taxed again. So any law is going to need to deal with that, and lawmakers will need to consider any sort of transition from the old system to the new system. And then the last issue to consider is that if you expect lower revenue, you have to answer how you're going to make up that reduced revenue. And lawmakers should think about ways to raise revenue that minimize economic distortions. Just like there's more than one way to levy taxes on corporations, there's more than one way to raise revenue from throughout the economy. And generally speaking, you want to raise revenue from domestic consumption rather than income, as it doesn't distort in saving and investment. And it has a relatively broad tax base. And if you can get away with it, doing that without raising the tax rate. So if the value-added tax can raise additional revenue by broadening the base to untaxed goods and services, that's the way to go before you decide to raise the tax rate. Generally speaking, you want to make your tax policy as universal as possible. You don't want to ring-fence any industries or certain types of business activity because that creates inherent unfairness. It also creates economic distortions that are ultimately harmful, even if politically they are things that lawmakers may want to do. So try to limit that as much as possible. I understand that financial firms can be a particular challenge in certain tax systems, but ultimately it's better to have a system that applies evenly across industries and business forms than it is to have one that targets certain industries or certain businesses of certain sizes with lower tax rates or different regimes. It's feasible from an economic standpoint. There's no reason that profits can't be taxed upon distribution in Germany, France, the United States. The limitation is always going to be political. In the United States, for example, it's not clear what lawmakers want to do with the corporate income tax. There's movements to reform it, but they're not movements in the direction of a distributed profits tax. And one way to frame this, or to think about this, is that small countries, it's not as though it's possible, it's something that might be beneficial to move in this direction. When you're a small economy, you're an open economy, open to foreign investment, it is beneficial to you to keep your taxes on that investment low to attract it so you can grow your economy. Larger economies, because they have a larger internal market, there's more investors located in that market, they can get away with having some regimes that that penalize new investment more than otherwise. But there are limits to that. Eventually, large economies do need to have neutral systems. They do need to encourage investment in some way. But I think we'll probably see the movement more towards smaller countries adopting these before we see large countries thinking about it. So it's always very difficult to prove causation with any sort of policy. When you enact a new tax, ultimately it's not going to be the only thing that's happening at that time. So why did investment change the way it did in Georgia when they enacted this tax? It's not clear. It's also possible that FDI could have been lower in the absence of this tax. So although it may have declined, it would have declined even more if they didn't enact this tax. And that's the important question, really, is what the impact of the tax is. You always have to think at the margin. So what was the effect of this policy on investment or economic growth, not the total effect or the total change in output during that time. One of the benefits of a distributed profits tax is that it reduces the tax burden on equity, which is typically taxed pretty heavily under a traditional corporate income tax. So as a result, it encourages companies to distribute income out, or it encourages companies to borrow money and finance investment with new debt. And across the economy, that can have negative consequences. So moving to this system and allowing companies to reshuffle towards more retained earnings on net is beneficial. However, there is a trade-off, which is that because the tax system is now based in part on this realization principle where you're only taxed when profits are ultimately distributed, there is an incentive to delay distributing profits as long as possible. Now, there are ways to fix that, and they were discussed during the conference. One way to make companies indifferent to when they distribute their profits is to fix the one area of a distributed profits tax where it still levies a positive tax burden, and that is on new equity. So if you were to allow companies to take a deduction for the issuance of new equity, you would eliminate this incentive to retain profits as long as possible to defer the tax. Because under a system of a pure cash flow system, your effective tax rate is 0 regardless of how long you hold on to your profits. And that would be taken care of in the Estonian system.